So FOMO investing versus long-term wealth creation. Today we are going to discuss this very important topic which affects pretty much all of us and all of us who are long-term investors. See, the mutual fund perspective in today's digital era, social media and instant financial news updates have fueled the fear of missing out, FOMO, on investment opportunities. Seeing others make quick profits from trending stocks or high-risk assets can tempt investors to jump in without proper research or strategy. However, such impulsive investing is often unsubstantiated and can lead to significant financial losses. Why? Because it's unsustainable. And we'll discuss that as we progress. On the other hand, long-term wealth creation through mutual funds offers a very structured and disciplined approach to financial growth, and which is sustainable. Let's explore the differences between FOMO investing and long-term wealth creation and understand why a mutual fund strategy or quality blue chip strategy or a disciplined strategy is a very, very smart choice. So let's understand what is this FOMO investing all about. See, FOMO investing refers to making impulsive investment decisions based on the fear of missing out on high returns. And why is this fueled? It is fueled by hype, social media trends, and short-term gains rather than solid fundamentals. See, how do you realize that you are part of a FOMO investing or you're falling into that trap? Now, what are the characteristics? Let's say chasing stocks or funds based on a hype rather than research. You watch news, you hear from your friends, you're discussing on your coffee table. So what this does is buying at market peaks and selling in panic during downturns. Frequent trading leading to high transaction costs is very, very expensive in the long run wealth creation process. Overexposure to speculative assets increases your portfolio risk, and this deteriorates your wealth creation journey. So what are the risks of FOMO investing? Market volatility. Stocks that rise sharply often correct just as quickly, leading to losses for late entrants. Emotional decision making. Fear and greed drive investments rather than rational planning. Lack of diversification. Investors may put all their money, in a single asset or sector, increasing risk. And very, very short-term focus. You ignore long-term growth potential in favor of quick gains. Long-term wealth creation with mutual funds. Unlike FOMO investing, long-term wealth creation focuses on consistent, disciplined investing with a well-balanced portfolio. See, mutual funds provide a diversified and professionally managed approach to growing wealth steadily over time. So why are mutual funds ideal for long-term wealth creation? First is and foremost is, and very important, is diversification. Mutual funds invest in multiple assets, reducing risk. Second is SIP, Systematic Investment Plan. SIP allows investors to very smartly invest regularly, avoiding market timing risks. Compounding benefits. The longer you stay invested, the more your money grows through compounding. And fourth is risk management. Professional fund managers are there. They adjust your portfolios based on market conditions and research. Now, what are the types of mutual funds for long-term wealth creation? First is equity funds. Very, very suitable for high growth potential over long-term investment horizons for your goals, which are long-term like children education, marriage, etc. or retirement. Debt funds, ideal for stability and risk management. They form very important part of your asset allocation. Ideal for short-term emergency funds. They are not linked to stock markets. Remember that. And they are tax efficient because the tax gets deferred. The third category is hybrid funds, a mix of equity and debt offering balanced growth. Ideal for people who are looking for SWP kind of solutions during their time. Now, how to shift from FOMO investing to a long-term strategy? So how do you do that? Set clear financial goals. Define your long-term objectives like retirement, buying a house, wealth accumulation, etc. Stick to a plan. Avoid knee-jerk reactions to market trends and follow a disciplined investment strategy related to your framework of investing. Diversify your portfolio. Spread investments across different mutual funds for balanced risk exposure like equity, hybrid, debt, etc. Invest through SIPs rather than lump sum timing. Don't try to time the market. Regular SIP investments reduce the market volatility impact. Review and adapt. Don't overreact. Periodic portfolio review helps ensure alignment with financial goals without impulsive decision making. So what are some of the psychological factors behind FOMO investing? See, FOMO investing is largely driven by psychological factors, emotional factors, which can cloud your judgment and lead to poor investment choices. What are some of the common biases which showcase or represent FOMO investing? The first is herd mentality. We all love herd mentality, following the crowd without independent research. The second is recency bias. We give more importance to recent events and ignore long-term trends based on data and facts. The third is confirmation bias. We try to seek information that supports preconceived beliefs rather than objectively analyzing data. Overconfidence bias. We believe that personal predictions will outperform market trends. Understanding these emotional biases can help investors adopt a more rational, data-driven approach to investing. So finally, what I would like to say is that patience pays off. While FOMO investing might seem exciting, glamorous, it often leads to emotional decisions and losses. Long-term wealth creation through mutual fund, on the other hand, might appear very unglamorous and boring, but it offers a very structured, disciplined, and sustainable approach to financial success. By focusing on consistent investing, diversification, and compounding, investors can truly build wealth over time without falling prey to market hype. Remember, in investing, patience and discipline. Again, I would like to repeat, patience and discipline always outperform impulsive decisions. Choose mutual funds wisely, stay invested, and watch your wealth grow steadily over time. The key to financial success is not jumping onto every trend, but staying committed to a well-planned investment journey. This blog is purely for educational purpose, by sab, and not to be treated as personal advice. Mutual funds are indeed subject to market risk, and read all the scheme-related documents carefully before you invest. Thank you so much.